Well, the loonie is pulling back today against its U.S. counterpart as investors brace for inflation reports out of the U.S. We'll also see some earnings start later this week with the big U.S. banks officially, unofficially kicking off the earnings season. Well, our next guest believes the Canadian dollar is fundamentally overvalued at the moment, and this month is most likely to be more positive for the U.S. dollar. For more on his outlook for currencies, we're joined by Shaun Osborne. He's a managing director and chief foreign exchange strategist at Scotiabank. Shaun, thanks so much for coming in.
Pleasure.
So you see the Canadian dollar as overvalued right now. Why is that?
Well, we had a big sell-off in the US dollar late last year. I think we're kind of in correction mode for the moment. And seasonally, the US dollar typically does quite well this time of year. So I think a combination of kind of technical factors with the US dollar getting heavily sold late last year, seasonal factors, and the Canadian dollar really moving a bit more than kind of underlying fundamentals would have suggested. Spreads have moved a little bit in the Canadian dollar's favour. Equity markets have picked up a little bit, but I think the US dollar sell-off that we saw through Q4 last year was really a little bit overzealous, overdone. We priced in a lot in terms of bad news for the US economy and interest rates, and now essentially we're seeing a bit of a correction in that, and that could run on for the next few weeks here, I think.
So that change in the fourth quarter, with the expectations that those interest rate cuts would be coming, that was influencing the US dollar?
Yeah, I think the build-up of expectation that we'd see a March rate cut. Late last year, we priced in almost a full 25 basis point rate cut at the March FOMC. We had the kind of concession from Chairman Powell that the FOMC were talking about cutting interest rates.
Right.
So that was a kind of cue for markets to really sort of look at this as a very realistic possibility. And we priced in, as I say, 25 basis points, more or less, into the swaps curve for March. Now we're back down to around 15 basis points of rate cuts priced in. So we've priced out 10, 12 basis points of rate hikes, rate cuts for the March meeting. And the US dollar has rebounded essentially because of that.
It's interesting to look at the Canadian dollar over the past year, and we're essentially trading around the spot where we were this time last year, right? Yeah. But I mean, a lot happened between then and now. And the factors influencing it, you highlighted that they've been shifting. Yeah. So how have they shifted?
Well, I think, the US dollar last year was really classically strong, I'd say, for the US dollar. It was a story of, particularly in the second half of the year, higher interest rates, stronger growth than expected. Interest rate increases kept running on more than anywhere close to anyone expected at the start of the year. So the US dollar really did benefit from that. And the story of US exceptionalism, stronger growth, higher interest rates relative to the rest of the world was really the power behind the dollar's strength. The Canadian dollar didn't really benefit from the kind of classic sort of Canadian dollar drivers. We've seen a bit of a detachment in the Canadian dollar from crude oil prices recently. It's become a little bit more attached to risk appetite and interest rate differentials. And I think that probably will continue in the near term here. So the CAD did relatively well compared to most of its sort of G10 peers. It got a bit of a ride along with the US dollar to a large extent last year. It appreciated against the euro, against the yen, and against the pound sterling, but it didn't do that well against the US dollar.
I think we've got one of your graphs that shows some of those factors and how they've changed over a 3-month period that we can bring up. But when you're talking about, there it is, when you're talking about the risk appetite and the Canadian dollar being sort of in line with that, why do you think that is, and why do you think it's going to continue?
It's a good question. It's a great question because clients often ask us, what is driving? We use this chart a lot in our publications to try and illustrate how these variables change over time. So the Canadian dollar, it's a commodity. We're a resource-based economy. We're still, heavily influenced by the commodity story. We're a kind of a high beta currency in the sense that we're very closely associated with global growth. Equity markets are kind of a proxy for the global growth outlook. So higher stocks generally mean a more positive environment for the Canadian dollar. Lower stocks generally mean the opposite. So weaker equities generally get us a weaker Canadian dollar. Stronger stocks usually get us a relatively stronger Canadian dollar. So
how do you see this year playing out? If that continues to sort of ring true, but then also the expectations for these interest rate cuts, the central bank in this country and in the U.S., the path might be similar, but it might not be the same. How could that potentially influence things?
Exactly that. I think, we're looking at a situation where if you look historically between the Fed and the Bank of Canada, interest rates generally move at more or less the same speed and in the same direction over time. But there is a fair degree of variance between when these cycles start and finish. Our call is for around 150 basis points of rate cuts from the Fed. This year?
This year.
This year.
Okay.
Yeah, but only 100 basis points from the Bank of Canada. So we have a sticky inflation problem here. We've started to see, as I said earlier, concessions from Fed policymakers that maybe they're starting to think about when they can cut rates now. We're seeing nothing of the sort from the Bank of Canada. We have a meeting coming up at the end of the month. I expect, a fairly measured statement from the bank that gives no concession to the outlook for rate cuts at this point. We had some soft jobs numbers last Friday, but within those job numbers was a very high wage growth number. And I think the Bank of Canada has made it pretty clear that that's something that they need to get a handle on before they can even think about the outlook for decreasing or relaxing monetary policy at this point. So we see slightly fewer, slightly slower rate cuts in Canada, narrower rate spreads. We can already see that short-term rate differentials are starting to move back in the Canadian dollar's favour. There's still an interest rate premium for the US dollar at this point, around 30 basis points at the short end of the curve. But that probably should disappear. We expect the overnight rate in Canada to reach 4% at the end of this year, and that'll be around about the same point as the Fed funds target rate, 4% by the end of this year. So
right, of course.
Essentially no difference in short-term rates between the US and Canada. So no rate premium for the US dollar, not necessarily a rate premium for Canada either, but the fact that we don't have a rate discount here in Canada should give the Canadian dollar a bit of a lift.
Very, very quickly, Shaun, this time next year then, what do you think for the Canadian dollar?
We're about where we should be right now, I think, in terms of underlying fundamentals. So 74, 75 cents is probably about where we should be. Okay. We may see a bit more softness in the short run, maybe another cent or so. At the end of this year, we're probably going to be trading close to 78 cents, I think.
78? Mm-hmm. Okay. Interesting.